Hello, everyone, and happy Saturday. Happy Small Business Saturday. It is Cheree, your favorite lender, here for a few minutes to talk a little bit about how to fund your real estate rental portfolio. We know that real estate is one of the cornerstones of wealth in this country. We have seen appreciation go up. We have seen cash flowing assets through rental portfolios. And today, you may be asking, well, how can I get the funding for these types of deals? So I am here to show you probably, I think, 4 or 5 different loans that you can use in order to uh, fund your real estate portfolio. So, first thing that I want to say is that yes, these are some of the secret loan programs that few investors know about. That I'm going to talk about today. The other thing I do want to say as well is as you are thinking about your rental portfolio, you do want to start with the strategy. It's important to start with the strategy of how many doors do you want to have ultimately? How many doors do you want to buy this year in 2024? Who's the team that's going to help you get those doors? And then hopefully, us as SimpliFunded, me as Cheree, your favorite lender, we will be a part of your team in order to help you get the deals that you're looking for so that you can grow your family wealth. But let's start off now with the DSCR loan. This is the very first loan that we're talking about here. So, DSCR stands for Debt Service Coverage Ratio. Debt service coverage ratio. This is a very popular loan with investors because it is a low documentation or low doc loan. So, if you've ever purchased a house for yourself, you will know that the amount of documents and documentation that's required is just overwhelming. The great thing about DSCR loans is that it is a low documentation loan. The reason for that is because the outside of just knowing your credit score, which needs to be a 660 or more, the approval of this loan is not based on your personal credit. It is only based on the numbers with regards to that house. So, what do I mean by that? This basically means that if you have a house where for every dollar that you're going to spend in principal, interest, taxes, and insurance, so basically your mortgage, you're going to get $1 at least of rental income from that property. Your loan will be approved as long as you have a minimum FICO score of 660. So, again, as long as for the principal, interest, taxes, and insurance, your mortgage that you have to pay out, as long as you're getting $1 in rental income, your mortgage will be approved as long as you have a 660 credit score. So this is a no income. You can be unemployed and get the DSCR loan. You can be underemployed and get the DSCR loan because it's not based on your income. The only asset verification that we have is with regards to the property itself. Now, I will say, take a step back there. There will be reserve requirements with regards to you will need anywhere from 6 to 12 months of the mortgage and savings. But guess what? That can be in your 401k. So you don't have to have that necessarily in cash in your bank account. You will just need to give us your 401k statement just to prove that you have that money on reserve. But other than that, you can buy 1 to 4 units with this loan. This is a great loan for people who want to build a rental portfolio. One caveat I will say is that actually I have 2 caveats. Number one is it is harder to get this loan if you do not own your own home, if you don't own a primary residence. The reason for that is because the underwriters are scared that you're going to use the DSCR loan for low verification, for low documentation, and then you're going to move into the property. So it is harder. It's not impossible. I have a client that was going to be able to get one, but it is harder. Okay. The second thing is that the lower your credit score, the more you're going to have to put down. So DSCR loans typically start at about 15% down. Um, it goes up to 30% down. So it's just something to think about as well with regards to DSCR loans. But these are great loans for you to use in order to start building your rental portfolio. The second loan is one that I'm actually working on now for a client. It is the one-time close renovation loan. Now, this is a conventional loan. There's actually two of them, two different names for it. One is called the home style renovation loan, and the other is called the choice renovation loan. But if you have ever gone into a property and you know that you want to purchase it as an investor and you want to rehab it as an investor, and then you want to, of course, put a family in there for long-term rental income, uh, you know oftentimes that you have to start off with getting a hard money loan, and then in 6 to 12 months, you have to refinance it into a permanent loan. Well, with these loans, you do not have to do any of that. You don't have to close twice. You can basically close one time and you can have the purchase and the renovation cost wrapped into that loan. So the tricky thing is that if you're buying this as a primary residence, you could buy 1 to 4 units. So let's say you're the type of person who wants to buy a fourplex, right? If you move in there, if it becomes your primary residence, you can actually get this loan, right? And I think you can get it for 5% down. Don't hold me to that. But if you call me or text me and ask me, I'll look it up again and make sure that that's correct. So you may find a fourplex and you may say, you know what, I'll move in here for a year and a half. I'll do the renovations with this property, and then I can actually have it be cash flowing, right? If you're truly going to buy it as an investment property, it can only be 1 unit. But I'm giving you some ideas with regards to how to add doors to your rental portfolio. So, a couple of times that you would use this loan is, of course, if the property has you know, repairs that need to be done. The repairs can be anything from the roof needs to be fixed to, it needs a new kitchen, it needs a new bathroom. The property is dated. It was built in 1970 and it hasn't been updated since. Things like that. You can use the funds for practically anything that needs to be done in the house. There are caveats with regards to if the house has structural issues, but any kind of cosmetic stuff or the roof or, things like that, the windows need to be changed, all of that can be wrapped into this loan. The $150,000 is the up to $150,000 in repairs or in repair costs can be included in this loan and in your mortgage. And it's a 30-year mortgage, and you can just pay off, it'll add 100, $200 a month to your mortgage every month. But that gives you more cash flow because then you don't have to go and get a HELOC or get a whole bunch of expensive credit cards or a second mortgage in order to pay for this. It can be all wrapped up into one mortgage. And the lender does pay the contractor directly. The lender pays the contractor directly. So once you have the contractor, you all have agreed on a budget, the lender approves the loan, then you basically can just, work with the contractor to do the renovation, but you don't have to worry about paying the contractor directly because that is what the lender does. So, hey, big discussion saying good morning, Cheree, just peeking in. I've seen you and Erica chat numerous times. Yes, thank you so much. Glad you are here. I'm not going to be here too long today. I just wanted to give a few more loan programs for you. So the next one is if you want to again purchase a multifamily for you to live in. It has to be your primary residence for this, but you can purchase a multifamily for 5% down if you're going to live in it. So what's the difference between what I just showed you and this loan? This is a conventional loan as well. This is a loan for if the multifamily does not require repairs, or if you're going to pay for those repairs out of pocket or some other way. But again, we're talking about adding more doors. You're able to add more doors by living in the property for a year, you know, renting out the other units. You can buy 2 to 4 units using this loan. And one thing to know, if you're buying it as a duplex, then you as a borrower needs to be able to afford the entire house payment by yourself. So you cannot include the rental income of the other tenant on the other side of the duplex. But if you buy a threeplex or a fourplex, then what we do is we use 75% of that rental income as part of your debt to income ratio. So this is a great way for you to be able to afford a multifamily with less money down through this conventional loan. So the next loan is, if you're like Cheree, but I want to buy the bigger multifamilies. Well, I will say this should not be your first purchase buying a 5+ multifamily. It's better for you to start off with a duplex or a triplex, etc. But some of my community, actually, you've been investing for a while and now you want to move up. Well, I've got access to a 5+ unit multifamily. I actually have access to 2 different lenders that I go to for these. And one of my lenders goes all the way up to $50 million. He will accept new and experienced investors. It's as little as 30% down payment. So, the lower your credit score and the lower your experience, the more money you're going to have to put down, which is why I suggest people you know, start with a triplex, a fourplex to get started. Own a couple of those first. That way you can get some experience with property management and things like that before you move up to the 5+ multi-unit. But if this is where you want to be in your journey, then definitely reach out to me and I can connect you with the right people. We can fill those loan applications out. And with these loans, obviously, you're looking at rent rolls, you're looking at the profit and loss statement from the previous owner in order to see how profitable the unit is. And also, of course, they're looking at any kind of deferred maintenance as well in order to value the property. So, this is one of my favorite loans. It is considered an investment property. It's called the Family Opportunity Mortgage, the Family Opportunity Mortgage. And it's basically if you have an aging parent and you want to purchase a home for them, you are able to purchase the home for mom or dad. So I call it the Don't Put Mom and Dad in a Nursing Home loan. But basically, the reason this is an investment property is because it is not your primary residence. You are buying this property for mom or dad. Before, I think it was the middle part of 2023, before then, you would have had to put 20% down. However, now they have rewritten the rules where now you're able to put just 5% down in order to get this loan. You can also use this loan if you have a child with disabilities. Okay. And basically, what you can do is have mom write you a rent check from her Social Security. Right. So this is how it becomes an investment property for you. And then over time, as mom or dad passes away, or they can't live there anymore for whatever reason, it becomes an investment property. Again, this is a conventional loan for people. So, this is, again, a great way for you to add more doors to you and your family's rental portfolio. With some of the loans that I have, there is a certain amount of lender discretion that's available, specifically for the DSCR loans and some of the other multifamily loans that we have. So, um, you know, oftentimes you'll have minimum reserves that are required to get these loans. However, depending on the lender that we go to, let's say you need to have 12 months of reserves and you only have 9. Well, we can talk to the underwriter directly, send them a letter of explanation, and oftentimes, they will relax that requirement for you to get that property. Um, all of the lenders have things like trade lines, a minimum number of trade lines, or minimum credit history. Again, they can relax some of those requirements as necessary. Payment history, if you have had issues with late fees or things like that, we can put in a letter of explanation for that. Judgments, collections, and tax liens, forbearance, loan amounts, and something called payment shock. There's lender discretion with regards to them waiving certain requirements that they normally have. All payment shock is if you're used to a payment of $1,000 a month for rent and you're all of a sudden going to go up to $3,000 a month in this mortgage, that's called payment shock because you have such a disparity between what you're paying now and what you are going to pay with this property. So again, non-QM lenders, QM stands for qualified mortgage. So these lenders, these alternative lenders do have more flexibility than a lot of the conventional products. The final thing is, if by chance you want to do fixing and flipping, especially in the DMV area, definitely reach out to me. We have money to loan. We close in 5 to 15 days. You just need a 660 credit score. You are going to be putting down about 25%. It's slightly higher rates and points, but we locally do our own lending and our own servicing of these loans. And what that means to you is as you buy the property and then you're fixing up the property and you need your contractor to be paid, our process for these fix and flip loans in the Metro DC area, the contractor gets paid a lot faster than if you go to some of the larger institutional organizations that are out there. So you will have 6 to 12 months to renovate a property. If you get it done in 3 months, great, no problem. But this is an option for all of my investors as well. So that is it. You can call, text me, 703-951-4419. I look forward to helping you build your rental portfolio, being your lender of choice. Again, 703-951-4419. Take care, and I hope you have a great weekend and a happy Saturday.